Hello, everyone. Today's conversation features Edmund Olotu of Bloc. Bloc is a Nigerian fintech infrastructure company that recently acquired Orchestrate. So, Edmund is the founder and chief innovation officer at Bloc, and it's great to have you on here, Edmund. Please introduce yourself to the audience.
Thank you very much, Emeka, for having us. So I'm Edmund Olotu, Chief Innovation Officer at Bloc. What that means really is that I work to guide the mission and vision of the company, work with all my C-level executives to ensure that we bring this vision of fintech infrastructure for global African companies to life.
Fantastic. Um, Thank you for being so gracious with your time, Edmund. We're here today, as you know, to talk about the acquisition of Orchestrate, but I think it'd be first helpful to the audience to understand a bit more about Block. All right, so as I understand it, the company was founded in 2009 as Tech Advance, which was a company that really specialized in the bill payments processing, particularly in the utility sector, right? But a lot of transitions have happened over time. And today, the company is an emerging player in the African fintech infrastructure space. So while we have you here, we just want to take the opportunity to hear directly from you. How would you describe Block? What does the company do? And then are there any figures you could share in terms of progress?
Okay, so Block emerged from Tech Advance as a Tech Advance started life really as a utility, infrastructure provider. So essentially building out bill payment platforms, building out aggregator platforms, collection technologies that allow companies to essentially participate in the electricity utility space as collection providers. So we started out really analog in terms of building out scratch cards and stuff like that, and then we moved into the API model. And from working within the API model, we realized that there was a lot more we could do beyond utility payments, right? So we acquired a PSSP license and a microfinance banking license, with the aim of really participating fully in the digital financial services space, right? And that is when we decided to rebrand the company into Block. Previously operating in the utility space, which is a heavy regulated market, it didn't allow for the same level of scalability that we wanted. So acquiring the licenses, transitioning to Block has positioned us to be a company that can go beyond just utility payments, right? We can now offer full service fintech infrastructure and banking as a service technology as a company. So
Fantastic.
yeah.
Go
So in
ahead.
terms of
Sorry, I
where
thought you were finished.
No. So in terms of where we are as a company now and what our product suite entails, so beyond the utility APIs that we provide agency banking tools that makes it very, very easy for any financial institution and indeed a non-financial institution to be able to offer agency banking as part of its suite of services. Beyond that as well, we have some transfer APIs, bulk payments APIs, and we're soon to release our bank account service that allows us to offer bank accounts as a service to not only fintech but to other companies that might need such a service to enable them collect payments or store value for their customers.
Fantastic. But as you think about this fintech infrastructure across Africa and specifically in Nigeria, you have other players like OnePipe, Woodcore, Pseudo Africa, Duplo, and others. So I guess the question for you is, as you see the landscape, how do you see your positioning within it? More to the point, how is Block differentiated from other players in the space?
Sure. So we have a couple of players in our space that are doing fantastic work, bringing fintech infrastructure very granularly to other companies and other fintech providers that need it in that space. And I think the collective work that we do helps to expand the market So it's a benefit for all of us, for everybody to kind of like play in their respective sectors. But where we see ourselves as playing slightly differently is in the fact that we started out really, really foundationally by acquiring our licenses. And because we have those licenses, we can build out proprietary technology. So you have a couple of players who do similar to what we do, but you also have others who aggregate technology from other licensed players, right? So they aggregate technology from the banks and some other larger fintechs, and then they provide that to fintechs, right? But for us, because we have the compliance ourselves, we're able to build out our own proprietary technology where, we have our own proprietary utility APIs. We're not aggregating. We integrated directly with the utility companies because historically we started out building technology for them. And then layering on top of that with our own banking license, where we can launch our own bank accounts, our own card schemes, and other features of a bank, except as a service to other fintechs. With our own PSFP licenses, we can also integrate directly to banks and integrate directly to the Nigerian Central Switch, which allows us offer transfer APIs and other type of card processing gateway technologies as well. So yeah, where we play differently is one, being very, very foundational about our compliance, and two, then building out proprietary technology on top of our own compliance and licenses.
Fantastic. So in terms of just interpreting that, it sounds like you've mentioned proprietary, foundational, primary effectively in terms of the acquisition of licenses. So it's really a full service offering as opposed to some of the other players. And as you think about building out that full service offering, it seems like one way companies do it and one way you've done it is in terms of acquisition, right? So inorganic growth, acquiring other companies out there. So I guess I'll just step back very quickly. At the start of the year, as Afri Digest, we wrote that we expect to see an uptick in M&A this year as one of the key trends to watch for, and that's certainly playing out, right? So to use a Nigerian example specifically, in Nigeria we've seen Trade Depot, which really operates in that B2B e-commerce supply chain and fintech space. We've seen them acquire Ghana's Trade Lion, who's a counterpart in the space, right? We've also seen Nigeria's auto tech player, AutoCheck, acquire a similar company in Morocco. We've seen in the classified space, Gigi acquire Ghana's Tonaton, all right? So all you have, acquisition kind of happening and bubbling up this year. But in terms of all the three examples I just mentioned are really deals that were done primarily to advance kind of geographic expansion, right? So your deal is a bit different, right? So obviously Block is primarily focused in Nigeria, Orchestrate is primarily focused in Nigeria. So there's not that expansion rationale, and your story seems to be a bit different, right? So while we have you here, it's going to be just very interesting to understand from you what was the rationale for this acquisition of Orchestrate and why the deal was done.
Okay, so I was introduced to Jerry, and his company at the time was called Get Wallets, before the pivot and rebrand to Orchestrate, through Hayden, one of our own investors in our company, Hayden of Rallycap. And it was very, very clear to me that we shared kind of like a common vision in terms of how we wanted to simplify how companies and other fintechs are able to access financial technology infrastructure. So having seen what he had and what he had built at that time, I realized that this would be a very, very strong complement to what we're doing, right? And there are two ways to do things, right? You can either decide to add it to your roadmap, and in another 2 years or so, you release, something similar, or you work with someone today and you accelerate your own roadmap, right? And in accelerating your roadmap, what that ultimately means is that you're offering more value to your customers sooner rather than later. We kind of like saw what both of us were doing, and we realized that it would be more complementary to both our companies and also to our customers if we can accelerate that roadmap to include that. There was also a secondary effect to that as well, is that Jerry and his team are very, very adept technically. Um, and it was good for me to have someone almost riding shotgun with me that goes beyond being, a business founder, like I am. I'm not technically adept. Um, I'm more of the kind of like the business, product vision guy. So it was good to have, I realized the advantage of having someone like him riding shotgun with me in building this out as well. So there were just multiple points where I felt like it was more of an advantage for us to be together than for us to not be together. Not only for our own internal kind of like stakeholder benefit, but in terms of also, you know, um, putting out infrastructure out into the market that would be very, very complementary to what fintechs are looking for right now. So yes, beyond geographic expansion, I think there is also the opportunity for M&A to happen to consolidate a vision and also to accelerate a product roadmap, bring it to market faster, give the market the benefit of the products, the combined products that both companies are building sooner rather than later. And that is exactly what drove our that's exactly what drove the opportunity for both of us to work together. So I think, yeah, slightly different in terms of the objective, but I think together, now that we're together, we're definitely looking out for geographical expansion opportunities now that we've managed to consolidate our visions together. And another final benefit of this as well is that whilst our initial core product or infrastructure product was around banking as a service, and fintech infrastructure was to come later, with this partnership, what happens is that the Orchestrate team can take our fintech infrastructure licenses, our PSSP licenses, and then really go hard on that aspect of the business. And like I said, we bring to market the benefit of our full suite infrastructure, sooner rather than later.
Got it. So it sounds like a lot of synergies, a lot of potential benefits in you guys, the core block team, I would say, being able to focus on the banking as a service side, right?
Yeah,
And then the orchestrate team really building out that fintech as a service side, right?
definitely.
So I think when you think about the interesting thing, or one of the interesting things to me about this deal is like you guys are both very early stage companies, right? And I think as you think about very early stage companies anywhere across the world, and certainly in Africa, it could be challenging to identify, acquisition targets with such potential synergies as you guys have with Orchestrate. It can be hard to negotiate deal structure and complete deals. So I just want to dive a bit deeper here, and I think the audience will really appreciate it. So I understand, as you mentioned, the Orchestrate acquisition was facilitated by one of your investors, Hayden at RallyCap. I also understand the consideration for the deal was a mix of cash and stock. And as you mentioned, now you have Jerry effectively joining as CTO, complementing you with that technical acumen and adeptness, right? And taking that, and that entire his entire team is joining you guys. So I guess the question for me that really interesting, and you talked about the introduction from Hayden, but can you just talk a bit more about how the acquisition technically came together? After you were introduced, what were the conversations like, and how did you guys both identify that this kind of marriage made sense?
Okay. So we had a series of conversations, and first of all, we were just understanding our vision, right? And essentially, it was also two founders who wanted to get a deal done, right? Sometimes some of these facilitations could happen, and one party doesn't really want it, and then conversations just break down later rather than sooner. But I think it was easy for us to identify early that it was something that we both wanted to do. We were slightly further along the way in the sense that we had existed, in one shape or form or the other. We had existing revenue lines from our utility business and other licenses that we had. So it was easy to see how what they were doing could easily plug into the roadmap, right? And I think the next question really was, is it something that they wanted to do? Is it an affiliation that they wanted to have? And would it be complementary for both of us to work together? Like I said, I felt it was complementary because it was technical. Um, um, and, I hope he thinks, and I'm sure he thinks, and I know he thinks the other way around as well. So it was easy for us. I think that the most important thing is being able to delineate what values um, each party brings to the table, and then also to understand fundamentally that if rather understand fundamentally if both parties want to do the transaction, and if both parties are aligned from a principle perspective, from a vision perspective for both companies, and if those things are there, then it's easy for every other thing to fit into play, right? um, and I think that's how this came to be, and this came to happen. And I think since then, the world has witnessed how amazing the product they're releasing has been. And overall, I think it was better done than not done, right? So yeah. Yes, there were a lot of conversations around what happens next, what how this should happen, initially, and until now, actually. um, One thing a lot of people do is immediately start trying to think how technology should fit together, right? Especially at an early stage, there is that temptation to be like, how does this work? They both should work together. And what would happen is that you get bogged down thinking about that and trying to make that happen, or trying to force that to happen inorganically, that ultimately you lose the reason why you were merging in the first place, right? You lose the reason why you were um, coming together. And I think we took that cue from larger companies, right? Because if you look at the 90s, um, a lot of the conversation around companies in the 90s and early 2000s were around mergers and acquisitions that became worse after they happened, right? And my own learning from that, because I'm a student of strategy, is that when they first come together, rather than everybody just kind of like you know taking a breather, immediately they want to see the effect of a full and forced integration, right? And that ultimately leads to a breakdown, because first you're thinking about laying off people because this person is not necessary and this person is not necessary. Immediately there's bad blood, between both sides. Then you're thinking of forcing a technology that's built in this manner to merge with another technology that's built in this manner. You're thinking about forcing, this corporate policies that exist in this company, forcing it on this company and vice versa. And that usually just leads to a period of extended tension, right? We decided that we didn't have to do that, right? That as far as we knew that this was the vision and this was the mission of both companies and they were aligned, then we'll allow it happen organically, right? And it was easy for me to then say, you know what, fintech infrastructure, I'm handing it over to you guys. We're not even going to try and build it. We're not going to attempt to build it. It is now your forte, right? And we would focus strictly on banking as a service. And whenever there's a crossover, the crossover would happen, right? And if an integration needs to happen, then it would happen organically, right? But we are not trying to like force feed each other anything. And I think that's what made this process extremely smooth for us. And I think it's a model that um, that other fintechs should kind of like be willing to adopt. And I'm happy. And a lot of the beauty of this is, since this happened, a lot of fintechs have come to me and say, hey, come talk me through how you made this happen and what you think you learned from that process, right? And and I've been happy to kind of like give them some pointers, right? And ultimately I'm hoping some of those questions actually do become proper relationships, and lead to consolidations within our market. Because as far as more companies survive in any capacity, whether as mergers or acquisitions, independently, especially during this downturn, I think is more of a benefit to the entire ecosystem, right? So, um, um, since this happened, I've had people, hit me up and say, "Hey, come help me talk me through this. What do you expect to happen, under this circumstance and stuff like that." And it's been ultimately very, very interesting.
No, fantastic. I think that's that's something that it'll be the deal itself. I think is a very interesting one for the ecosystem, right? So you talked about a few things. I want to kind of be mindful of your time, but we haven't really talked too much about the product of Orchestrate itself, right? But in terms of payment orchestration, it's one of the few players in that space on the continent, right? So it's certainly a unique product, and it sounds like a stellar fit between you guys, and that's what I imagine is driving this kind of inbound interest to you. But one thing for me that I think will be interesting for a lot of people is to now, you have experience in, now M&A on the continent. Not a lot of people have that, right? You have experience, from, 2009 and beyond in the fintech space, first in payments, now kind of in more infrastructure. You have experience in business pivots. You have experience in acquiring fintech licenses. So just kind of want to, I guess, have one question on these areas to kind of help our audience kind of understand a bit more about the future, how you build in Africa, right? So first, I guess, to your last point, just if you speak broadly and generally, what would you say are some of the challenges of getting tech and M&A deals done in Africa? If you think back, you said your deal was kind of smooth, but what were some of the more challenging points of getting that deal done? So just what are some broad challenges of getting tech and M&A deals done on the continent, and what can startups do to try to mitigate these challenges?
I think the key thing is really alignment, right? Alignment is really, really important, right? Because what you have in some of these instances is, and especially, it's a nascent ecosystem. A lot of money came in, a lot of money has come in, and a lot of people don't know how industry dynamics change over time. Um, um, for me, I kind of like, I've had that experience. I've been a founder essentially for all my career, right? So, came out of school and immediately um, began that process of being a founder, of being an entrepreneur. So I've seen industries change. I've seen how things could happen for your benefit, and then the next day, that benefit doesn't exist anymore. So I come into this space, or rather, I remain in this space with a certain sense of humility, and I think that has enabled me to kind of like navigate my way through, um, and I put it this way, a Nigerian tech ecosystem, which is slightly different from every other, so that's slightly different from every other ecosystem. So I think the first pointer is, and I made reference to it before. The two founders want to do a deal, right? If two founders want to do a deal, then it's done. If it looks like one founder is begging another founder or forcing another founder, then I can assure you that somewhere along the line, the deal would trip up, right? So a lot of people have to kind of like tuck in their egos, have to be very, very rational about how they're thinking about it, have to be very, very rational about if they truly believe both companies together equals better, right? For both parties, not better for one party, but better for both parties, right? And I think once that alignment is clear, every other thing, fits into play, right? Another thing as well is also identifying what's real and what's not real, right? Valuations are unreal, right? What real is really what exists on ground, right? And sometimes some people allow themselves to be led by valuation and not be led by what really and truly exists, foundationally within a company. If you're in a hot space, your valuation is going to be crazy, right? But that does not necessarily mean you have certain assets, certain balance sheets, certain product attributes that demands your company has that value you attribute to your industry, right? Understanding that and coming to that realization with a sense of humility is also important in kind of like putting these type of deals together. So I think that would be the first thing a lot of founders will have to navigate through in terms of doing these deals, because we're coming off the back of an industry that is exceptionally hot. A lot of money has flowed through it, and many of these M&As might be motivated by the recent downturn as opposed to being motivated by bountifulness, right? And that's a thing, right? When, to be honest, when we started our own um, M&A process, leading to the ultimate announcement, we were still in a period of bountifulness, right? Or in a period of bounty, right? So we were two founders, coming in, where there was enough, there was excess in the market, right? And that was a good thing because we could have easily gone our separate ways and done stuff together, right? But coming together in that period really, really solidified the relationship, right? Now we're having another situation where there's a market downturn, all that, bounty doesn't exist, so to speak, and you're going to see companies coming together now, and it's a good decision for them to come together now, to survive this type of period, um, you know, but that also has an impact on the psyche of the founders when they come together, right? Um, you know, and are they willing to?
I can't help but think of forced marriages.
Exactly. So are they willing to kind of like, put ego aside? Are they willing to see the bigger picture for each other? Are they willing to identify the synergies first before they identify the differences? Um, and are they just willing to kind of like just work together through the marriage, so to speak? So um, I think the first thing is, really identifying the soft aspects and getting that cleared away before thinking about the hard aspect. If you go straight for the hard aspect, what are the numbers? What's the product? Who's there? Who's not there? Before even tidying up, do we really want to do this? Do we really want to work through this? Are we aligned from a principle perspective? Then you might ultimately get tripped up later.
Got it. And what tips would you give to other, emerging founders in navigating that landscape?
Um, I think ultimately valuations correct themselves, right? Um, whether it's today or later, a valuation will correct itself, right? Um, because at the point where you're exiting or you're being bought, the numbers then would really matter, right? Going through multiple rounds of funding, those are safe agreements, right? And I think as far as a founder can survive today and give himself some upside protection later, if they exceed expectations, I think founders should be um, a little bit less, what's it called? A little bit less sentimentally attached to, um, would I say, to ownership, right? And this might seem like bad advice, right? But again, having survived multiple downtimes in my career, I know that the most important thing is to survive, right? Don't price yourself out of the market to the point where your company dies, right? When what you would have done would have been to price yourself in the market, survive, and then protect yourself for upside later, right? And again, it's also having good advisors and having good people work around you, your lawyers and everything. A lot of times when we do these things, we forget the impact of lawyers and advisors, and we just go into these transactions. It's always good for a founder to have either a business advisor, a board advisor, or a lawyer or a consultant they work with that can help them navigate some of these things, right? Because most of the time we just don't have the knowledge because we've just not been in the industry long enough to have the knowledge, right? Some of these founders, fresh out of school, built a great technology, no real world work experience in that corporate type setting. It's easy to get run over and railroaded by folks who have been doing that for a very long time. So as far as you can identify someone who can help you and guide you, pull the person close, do what it takes to survive and protect yourself for a future, upside later. As far as you're really sure of your vision, you're really sure of your product and what you're offering, and your ability to deliver what you say to your market. That's how I think about life in the in the down round, and I've been through, or in the downtimes, and I've been through multiple of them. Um, the first company I founded was Snapbang in the middle of, a recession. But ultimately, I got the value, I wanted from it later on when it exited. And I think that playbooks can serve everybody else. But at the same time, don't do a transaction that would keep you demotivated, right? You have to do a transaction and feel motivated by the transaction the next morning. You want to go ahead. You want to make sure that you're working with people that would support you, and you're going to work with people who would see your value later when you've gone over and beyond for them in your execution of the company's mandate.
Fantastic. I guess the final question for you, and I'll just let you go, is about pivots, right? So you have experience in, bountiful markets, and you have experience in not so bountiful markets, right? So just, I think a lot of founders get started, and I guess, sometimes things, the market,
Yeah.
will reveal all, right? You don't know how things are, will happen. So just cutting right to the chase, what advice would you give founders about when to pivot from an original idea or steer the business in a different
Oof,
direction?
that's a tough one, right? Are you pivoting because you truly believe you can solve a problem, or are you pivoting because you just want to survive, right? Um, that is key, right? You have to understand your motivation for pivoting, right? It's almost like changing jobs. Are you changing job because it's going to help your career progression, or are you changing jobs just because you just you want to move sideways, right? Within an industry or something, right? Because not because you can build a product, or your ability to build a product rapidly, right, does not necessarily mean that you're the person to solve a problem, right? So when you want to pivot, you have to ask yourself, am I the person to solve the problem beyond my ability to build a product, right? Am I the person who can solve this problem, right? And if you're the person who can solve this problem, then go ahead, right? Your pivot will be felt in the industry because your ability to communicate the new vision and new mission of your company will be extremely succinct, and it would resonate with people, and it will resonate with your market. But if because you can build a product, you just want to pivot just because things are not going well with what you currently have, however, you don't have the intrinsic ability um, to solve that problem for the market, it would also become exposed fairly quickly as well. So I think for me, really is, um, doing a deep dive and asking yourself, right? As I'm pivoting, am I best placed to solve this problem for this market, or am I just pivoting because I have the technical ability to build a product? So that would be, yeah.
Fantastic. Awesome. No, so I mean, I think this has all been helpful. Very interesting conversation to understand a bit more, kind of, about Block, about Orchestrate, about how deals get done, and the fintech space in general. I just want to give you the opportunity, just for a last word, perhaps talk about the future of Block. What you're excited about, or
Okay,
and so forth.
great. I think for us, we're just really excited for people to see. Um, what the Orchestrate product can do, and what it currently does. It's a fantastic piece of payment infrastructure. Um, near, we like to call it near no code, or near zero code. It's a near zero code product that allows you to do a lot of things with payments, right? Rather, from um, accepting multiple payment types to profiling how your current customers pay, your ability to use a dashboard to create multiple kind of like payment instruments, from discounts to rewards and stuff like that. Being able to accept payments from multiple geographies. Currently, we have Nigeria, South Africa, Ghana, Egypt, and the USA. Integration with more than 11, payment partners, from Stripe to the crypto guys and everything else. So I think for us, just really allowing the world to see what that means, the kind of value it gives to companies, right? So either merchants or fintechs. Typically, what would happen is that you would have your own full suite payment team, kind of like building out just payments, and that's a distraction from your core focus. But working with us, you have literally no code built into your technology, and we do the rest of that for you, so you can focus on your core competence or your core product offering, rather than having to build out kind of like a parallel payments team building out stuff for you. So that's really, really interesting for us. I think also going deeper on the banking as a service side, launching our accounts, launching our card products, and then just, having people see, this, how both companies work together, right? So the way we try to see it is, we're building infrastructure that allows companies to either build with us, grow with us, or protect their value with us, right? That's how we see it. So we want people to essentially see that mission come to life, right? And see it come to life through the product we put out in the market. So over the next year, it's going to be really, really interesting for us. We can't wait, for people to kind of like see how everything kind of like works together, right? Taking it from how we plan it internally to people, feeling it when they use our products.